I've never seen so many different opinions from experts and from investment strategists on what they think is going to happen. So of course we got it all right. Most of them got it wrong. So we're going to look at this. But our theme has been wag the dog, and that's where something less influence impacts something of greater influence. And in this case, we're thinking the inflation will eventually get to the Fed and they're going to pause, which we believe this year, and then that will cause a potential bull market to continue. All right, so I like the wall of worry. This is what investment strategists are thinking about, what they believe is going to happen. And I would have to say that almost the majority of investment strategists are negative. They have been all year. So they've missed most of this market move. One particular hedge fund manager in Connecticut was frustrated because he's missed the whole move because his macro analysis said to be out of the market. He expected lower lows from October. And so he's missed this whole thing. And now what does he do? And we're going to look at a number of things about potentially why this may be a bull market, but we think it's going to pull back. So we're going to talk about that. So, and many strategists say, hey, we're just in a bear market rally. And like the 30s and 70s, this is going to reverse. And we're just right now kind of in this temporary zone, but the markets are going to pull back and maybe go to new lows. So, and also they believe that corporate profits are too high. The expectation for corporate profits are too high, meaning that there's going to be a great reduction in the analyst forecasts as we move forward. However, we're taking the opposite side. And remember, we've been bullish all year, which has been the right move, right place to be. So we've been a little contrary. There's a few of us out there, but it's certainly the minority. The majority has missed it. So many are thinking that corporate profits are going to come down. We believe that it's bottomed, and we'll talk about that. Inverted yield curve is confirming a earnings collapse. We've been in an yield inverted situation for quite a while. That's where the shorter term yields are higher than the longer term yields. And that's the case right now. Short term yields are much higher than the higher duration yields. So what that typically means is that we're going into a big recession. Many people have said we're going to go into a recession. However, the GDP just came out revised for the first quarter, and it went from 1.6 or something to over 2%. So actually, they underestimated how strong the economy was in the first quarter. So many people have gotten that wrong. And of course, you've heard that there's going to be an earnings recession all year long. We said it would not happen, but it hasn't happened. Many people said it's going to come. It's going to come. If you say it long enough, how many know you'll eventually be right? But we have been right on this. So inflation will remain sticky. This is what they're saying. So it's going to be tough for the Fed to get to their 2% target. Fed will keep rates high, not just this year, but even into next year. So they're not many earlier, about I'd say 2 months ago, many analysts said that they're going to lower rates this year. We don't believe that they're not going to lower rates this year. We're going to believe they're holding steady, but we do think they will sometime in 24. And the weakest economic quarters are ahead of us. There's too many headwinds, and they're expecting a recession to come. We are expecting a recession, maybe early 24, but we do think it's going to be very mild. Originally, we said soft landing or soft recession. We kind of dropped the soft landing, although I may put it back in because the market does seem like we're going to be in potentially a soft landing. But we do think we'll end up in a recession eventually. And many think it's too late to get in stocks now. We actually have a higher target than where we are now in the S&P 500 by the end of the year. So we're on the other side. Resumption of student loan payments. Many young people are going to have to start making payments. Remember, because of the pandemic, they said you don't have to make a payment on your student loans. Well, now that's coming. So what are they? They're consumers. They're a big part of the consuming, which impacts our GDP. but now they're going to have to pay an estimate of $250 more per month. Well, that's $250 they're not going to be spending elsewhere. So they're going to have to go back. That's going to have some impact on the economy. And the commercial real estate is a looming disaster. Now, we do think there's risk, but we're already seeing bigger companies coming and buying the weaker ones. And the A+ buildings are being bought at discounts. So this seems to be buyers. But what's the problem? Rates have come up, and there's a large number of refinancing that's coming this year and next year. Well, if the rates are this high and the occupancy rate is very low because a lot of people are working from home, so they're not going back in. So there's a high emptiness in the commercial real estate. So that's a problem that could happen. But overall, most analysts are saying we're going to go to a new low. October was just the beginning. We're going to go lower because the economy is going to fall apart. Corporate earnings are going to fall apart. We have not been in that camp. We've been in a more bullish camp. Now, so here is our positive. Yeah, May CPA inflation data and the PPI are showing inflation is still coming down. Not as fast as it was, but it's still heading in a deflationary trend. Also, if you look at the Fed's looking at 2 more hikes, and Powell just confirmed that. Now with the GDP this high, revised upward in the first quarter, I think they're going to do 25 basis point in July, and they meet again in September. And I think they're going to do another 25 basis points. But that's it. That's stop. That's bullish. We know there's light at the end of the tunnel. We know it's going to end soon. So we think that's very bullish. If you look historically, stocks and bonds do well once the Fed stops. We kind of have some insight. We got 2 more to go. And what happens if they only do 1 more? Because inflation drops big time the next few months. Well, that would even be more bullish. But even with September, we think it's going to mean a rally at the end of the year. So that's why we're bullish to the end of the year. Consumers are still resilient, especially in services. Everybody's flying. Everybody's still going on vacation, like Eric. He's going fishing. He's going here and there. I wish I could be just in yours. Can you put me?
Personally,
Yeah, when you got 8 kids, he's keeping the whole thing held up. So households still in good financial shape. There's a lot of cash. There's a lot of low debt service compared to history. So the most families are not in stress. There's some are, but if you look at the averages, the numbers look very good. And there's huge amounts of cash on the sidelines. What if that money turns bullish? We're at like record high institutional cash in money market funds. We're at record high retail in money market funds. Why is that? Because there's a high yield being paid right now for very short-term instruments. And so people say, I don't want to risk because I'm just going to go in here. And so there's a ton of money. But if they decide, or a big percentage of that group decides, hey, I think stocks are going to do well over the next 12 months to 18 months, you're going to see a big push up in the stock prices as they re-enter. But there's a lot of money there, a lot of gunpowder on the sidelines. And we think corporate earnings forecasts, remember the analysts have been wrong. We've been saying there would be no disaster in corporate earnings the whole way through this year. Analysts said, hey, there's going to be a corporate, and they've been wrong because the companies keep beating their analysts' earnings. Well, now that's turning around where they're not lowering the expectation. They're beginning to bottom and even raising the corporate expectation of corporate earnings going forward. That's a positive. And also, if you have a strong beginning in the S&P 5 index, especially if you come out of a negative year last year, that is very bullish for the next half. And we'll look at some historical charts on that. So these are all the reasons why you should be buying. Huh.
I added a graphic for you.
I'm not scared me. The stock market enters bull. All right. It has officially, because since the October low, we went up 20%, and that's sort of the number that somebody decided that, hey, that's a bull market. So they say we're in a bull market. You can see that coming off the bottom. The S&P 500 index, it broke the 200-day moving average a while ago. But this is what we're interested in. You can see it peaked here, peaked there, peaked there. This is the relative strength of the S&P 500. So we took something off the table. Now, we maybe did it right here, but we think it's coming down. We think we decided to take 20% of the equity position and put it into short-term treasuries. So we think there's an opportunity here for the market to drop maybe 5%, and then we're going back in. And we got to capture that 5%. That's my forecast. We're going to come down at some level, and then there'll be maybe it will come down to here, and there'll be some opportunity to get back in a little better pricing. But we're still 80% invested. We were 100% until a few weeks ago. Okay, so this particular move from October is maybe a little below the averages, but it's not bad. It's very similar. The median, the average, the median here, average there. It's a little. We haven't had a great bull market, but it's not bad, and it's gaining. You can see the lines gaining on the averages and the median. So this has been a typical rally here from the bottom. Not unusual. Now this is interesting. You reworked all my charts.
Well, I had to make room on this.
All right. Okay. So this is showing what happens historically. Historically, if you have a good first half, a 10% plus first half. We had a 13%. So the red box shows what happens when you have let's say last year was positive return. Well, look at, you get an 8% and an 82% win, and the full year, you get another 8% for the second half, 25% for the total year. Now, what happens if last year was negative? Historically, you get a 12% the second half and a 30% this total for the year to date. This is, and it's happened almost 90% of the time, 9 out of 10 times. There's one time it didn't. So this is boding well that we're going to end up with a strong second half. All right, can stocks go up despite all the negativity of hedge funds, institutions, market strategists? There was a survey, the average equity exposure for high net worth individuals, 25%. Hedge funds, many smart money have missed this rally. We captured the rally. So can they go up even though they're so negative? Well, let's look. Historically, 2003, you can see a -50 in a bear market. And you can see that about 3 months out, it rallied to 25%. But investors said there's going to drop another 15. Investors said we're not negative enough. So there was a lot of bears. But what happened? It continued upward. So a lot of negativity in 2003, but the market kept going up. So you may have a lot of people saying, hey, this is going to go back down. It's a bear market rally. It's going to go back to the bear market. Well, it didn't in 2003. Let's look at 2009, the great financial. Remember, we had the rally off the bottom in March. It rallied to here. And so people said a big decline's coming. It's not over. Said this, like the 30s and the 70s, when there was bear market rallies, and then it went to a new low. That's where we're at. And guess what happened? Just kept going. So the idea here is that you can have cable news, all the people on the financial broadcasting systems can be negative. Many can be negative, but the market still goes up. Another one, this is more related to us because it came out of a high inflation period. You can see there was a bear market, and Volcker speaks of ending this war on inflation, just talked about it at this point. And so investors were saying, we're as bearish as ever. Corporate earnings are coming down. Does that sound familiar? And sell now. You saw that in a lot of the financial publications. What happened? Boom. So the point is, you can have a lot of negativity on cable news, but the market can still go up. All right. Here's the huge amounts of cash. The left side is institutions. You can see how much cash is in money market funds, and the right side is retail. That's a lot of money. You can see all the way back to the early January 20. We have a ton of money sitting on the sidelines, lots of gunpowder. What happens if that goes bullish, or a portion of it goes bullish? There's plenty of money to come into the market to boost the returns. Any questions? Okay.
And just a reminder, anybody online, you can post it in the comments section and I will see those and I can get those questions to Tom as well.
Okay. The economy is showing some signs of slowing down. Not much, but it is kind of tilting over. Now, we did get a revision again in the first quarter that the GDP was raised up over 2%. But it's going to be interesting what the second quarter and the third quarter specifically. But there are some signs. This is the leading indicators. And you can see that it's come down. And these are recessions. See the gray areas? You can see that drops down and a recession comes. Well, look where we are today. It's heading in that direction. And there was just a very short recession during the pandemic. But you can see it can lead, and going into the recession, it's coming south, going south. So we are right now. The leading indicators are showing a drop in their the CB leading indicator index. Also, the labor market. There's more jobless claims. You can see that bottom here, had another bottom there, but look where it's going. Jobless, it's slowly creeping up. And we're going to see what happens to the unemployment rate as we move forward. And, however, inflation's coming down. And you can see that in the CPI, and also ISM prices paid. That's the wholesale prices. The companies that sell you things, what are they paying? And you can see those are both coming down, both in services and manufacturing. That's a good sign because eventually that will get into our pricing as the companies won't be able to continue gouge us. All right, so there's 2 more hikes coming, even though inflation, we think that's it. They're going to hold there. Now, and again, we don't think they're going to lower rates in 23, but we think they will in 24. So right now, that's where the Fed estimate is, all the way up to 5.6. So there's 2 more 25 basis points coming. They've announced it. That's what they're telling. It was reiterated just the other day with Fed Chair Powell. So we expect that to happen. Now, the bullish case here is that they stop and they're not going to raise it anymore. That is when bonds and stocks do very well. Okay, so what's our outlook? This is only good today. Anybody get that? All right.
I got it.
Okay. So after I walk out, this is no good anymore. All right. So what we are is wag the dog is still that inflation is going to stop the Fed. We've been saying that all year. It's taken longer than we expected, but we're neutral on stocks right now. But we're bullish for the whole year. We think there is going to be a short-term pullback coming, and we think corporate earnings, all the forecasts are going to bottom, and they're going to start raising forecasts in companies. That's all positive for stocks. The Fed stops in September, maybe July, leading to a rally to the year end. That's our forecast. Huge amounts of cash on sidelines bolsters second rally, so there'll be plenty of money to actually keep the second half rally going. Market's going to remain volatile. It's but we will not go back to the October lows. We're not forecasting that at all. And soft recession end of 23 or early 24, probably 24 before we see that, but no deep recession, which means the stock market can continue to do well. So expect 2 forward, 1 back. And right now I'm in the 1 back. We're betting on the 1 back so we can go in and buy back our 20% at a lower rate. And then our forecast hasn't changed. It's the same for 4,600 for the S&P 500 by the end of the year. Rally continues after a short pullback. That's our forecast right now. There's going to be a pullback this summer sometime. And we're set up for that. Now, we could be wrong, but we only have 20% on the sidelines, making some pretty good interest rates. So I'm not overly worried about it. We just took some risk off the table. How many think that's probably a good idea? How many don't think it's a good idea? All right, so that's our theme, forecast for the rest of this year. And we will see how it pans out. Any questions?
Just a reminder, if you're online and you have a question, you can go ahead and post it in the comments section or email me directly. I will get those to Tom here for you.
And I'm excited for the next presentation that we're all going to live to 100.
I watched on TV, they showed the NASDAQ and the S&P and everything on TV. Well, it went up today, down yesterday, going up tomorrow. It goes back and forth. Is it?
Yeah, it's consolidating. And we think if we're right, we're going to see a little drop, maybe 5%. And then that will be, and if everything's still put in the right places, then we'll go ahead and redeploy our 20%. But we took some risk off. We thought it was appropriate. Remember, we're one of the few that were bullish, 100% invested all year. So, and we were right on that. So hopefully we'll be right on this. If I get this right, I need a bonus.
Eric will give you one.
Don't
worry.
If you're right, we're going to add you to the next slide too.
Yeah, there you
Remember
go.
your quotes?
Oh, yeah.
Yeah.
Remember, this was, I said, I kind of summarized this. Where is it? Is it gone? Is it gone again?
I clicked the wrong button.
All right. Long-term investing, and those online, listen. So delayed gratification, that's the best way to be as an investor. Charlie Munger, Warren Buffett, they run Berkshire Hathaway, Joel Gramblatt, and other legendary investors. Peter Lynch didn't build fortunes by panicking during recessions. They stayed the course. They didn't sell out in 2008 or 20 or make impulsive decisions, even though there were plenty of negative headlines. They build fortunes because of an uncanny ability to ignore the noise, the gloom sound bites. Is there a lot of noise out there? Gloomy sound bites. They ignored it. And all the pundits, they compounded their wealth again and again thanks to delayed gratification. So these are successful long-term investors. Many investors beat the S&P 500 over many years because they maintain a long-term view. So as an investor, even as you get up, you have to be longer term in your thinking, not monthly, quarterly, daily, ups and downs, but you're really thinking long term. Great investors tend to think like owners when they buy a stock that's like buying a business. And this one is by Jeff Bezos. He said, everything you do needs to work on a 3-year time horizon. If everything, then you're competing against a lot of people. But if you have a 7-year horizon, you're competing against very few people. And so we have to be long-term investors, because that's how, if you let your emotions get involved, that's when you make bad decisions. That's where you get out at the bottom and you buy at the top. So you let us as professionals help you navigate this. We don't use an emotional approach. We use a fact, quantitative system, experience system to make our decisions. So that's why you have entrusted your money to Eric Hagan and Rhonda and Dan.
And Dave.
Maryland.
And Maryland.
Okay.
If I may, I'll add to that because I think the most predominantly used strategy that we're running right now is the wide moat strategy. And to help people understand what that is, I actually not long ago took $25,000 of my own money, opened up a separate account for just that money, put it in, and I'm only investing that money in the wide moat strategy. So now I can show you my personal account performance numbers on that strategy. Now, again, I have all of that account invested in just those 30 stocks, right? Some people have 20%, 50%, 75%. Very few have all of their money in the stock market, the way that this account is invested. So be clear that everybody's allocation is unique. That's one of the things that we pride ourselves on, is that we take the time to look at every single account that we're managing and allocate it appropriately. However, most of our clients, most of the people that we work with, hundreds of accounts, most of them do have exposure to wide moat. And I would argue everyone in the room has exposure to this wide moat strategy. So I thought, with this as a backdrop, I thought I would show just kind of how things are going year to date. So this is actual performance of my account, that account that I just referenced, that one $25,000 account. If we look at the blue column, you'll see the performance of the account at 19.84% year to date. So you see this down here? That's year to date on the wide moat stocks versus the S&P 500 at 1494, which I highlighted up there at the top. But the stay the course message, to Tom's credit, in this severely negative sentiment environment is working. Job well done.
Yeah, and it's the type of companies that we just talked about, like you're buying a business, rock solid, like Warren Buffett.
Did you just take that money? Was there a strategic time that you plug that in, or?
I started it last fall, so this is just a year-to-date number for you.
So yeah, I understand,
Yep.
but was there something in the market that told you just do it, or you just wanted to see what it would do?
A light went off in my head,
Okay.
and here's what I mean by that. 2023 marks 20 years for me helping people like you do this. And over the years, countless times, people have asked me, Eric, I'm coming from wherever. Will you just invest my money the same way you're investing your own? And it finally hit me. Well, why don't I offer that? So why don't I do exactly what people have been asking me to do? And so there is a new initiative. If you have kids, grandkids in their accumulation years, different environment than those of you in the room. Okay, so keep that in mind. And you want to help them grow their money, whether it's an IRA, Roth IRA, individual account, what have you. I have a website set up called investlikeeric.com. You just go to that site. You can get all the details of this. So it was less, Mike, a time that I said, oh, the market looks like it's a good time to do it, and more, this light went off and said, well, why don't I build an offering around that to help people learn about investing? We just had a client who heard about this, wants their daughter to get involved in this. And so they actually gifted $25,000 to their daughter, and we're investing it exactly the same way I'm investing my own money, so that she can start to learn what it means to invest and own stocks and see individual holdings in her account. I had another gentleman actually from Indiana see the presentation and say, I have been trying to figure out how to do exactly what you're doing on my own, because to what Tom was saying earlier, there's no emotion involved. The stocks I'm in are not based on Eric's gut feeling about what's going to do well moving forward. It's based on a strategic approach that removes the emotion, inserts the discipline, and makes changes when it makes sense from a lot of different perspectives, but one that it doesn't incorporate is emotion. And so this can be used in a lot of different ways. But if you'd like all the details, go to that webpage. I have 2 updates that I've done since investing that money. So I did a first quarter update. I'll do a second quarter update here probably next week, just to show kind of these numbers. But I wasn't planning on going that deep today, but it's something to report to you guys. Yeah.
So instead of $25,000, why isn't all of your money in that?
Well, the vast majority of it is, to be clear, but I also have money in some of our other strategies, like our aggressive sleeve, the thematic sleeve that Tom was just talking about that we went to cash or almost out into bonds with. So there's other strategies that I do have other of my money in. I also have a little bit of fun money where I make some bets on some individual stocks that I would never recommend anybody do. Because it's the TV show Mad Money, where you can it's mad money. It's money you can afford to lose. So it's a little bets on individual stocks, but vast majority of everything that I have is in exactly the smart mix strategies that we manage. Absolutely. Okay, but to that point, everybody's different, right? Yeah, I'll leave it at that. Any other questions about Tom's message here today? Let's check the comments section here again. Email. Right. I don't see any other questions coming in. So going once. I do. You know what? I do have one more question for you, Tom.
Okay.
You mentioned you're looking at that relative strength chart, and you mentioned I'm kind of anticipating a 5% pullback. Is that your base case, your low end? Do you have a high end that you think we could hit?
Yeah, I have a
Is
range,
there a range? What give us
but
any
it's,
insight that you have
yeah.
into that
So
range?
when we were expecting a drop of some kind, we don't know what it's going to be. And it's going to be short-lived, we believe, and then it's going to continue up all the way into the year end. So it all depends on the information, the data that's there when we are there. So it will be data driven based on when it drops. Hopefully it drops. It may just keep going, but if it doesn't and it comes down like we think it is, then we're going to look at what's going on in the market, what brought it down X amount of percent, and then make our decision from there. So it's data, like the Fed, we're data driven.
Data driven.
Yeah.
Love it. Appreciate that. All right, going once, going twice. Any other? Yes, Howie. Love it.
I'm
Pressure's
looking at
on.
Tom's picture there. Looks like Tom's lost a little weight.
Now, you know what? I have. I've been riding my bike 8 miles like 5 times a week.
Really?
Yeah. Yeah.
Wow.
So and it's hard riding. So, and my knee is great. I'm not in pain yet, like last time. So
Good
What
for you.
was that quote we were talking about at the beginning today? Who had that quote?
The object is to die young as late as possible.
The goal of life is to die young as late as possible. I like
yeah,
that.
I have. So my wife's happy. I was on her program, but she said, "You're going to do this." So I obeyed her. No, it's quantity, your intake is a big part of that. So I cut back on the intake. So,
Cool.
and then worked out even more. So you take those two, lower intake and work out harder, boom,
See,
good results. I'm not in any Oprah program or anything like that. Or she'll come out with a new book of the new diet. What happened to the old one?
Well, you better stick around for the next message. So in a few
Yeah.
minutes here, we're going to be joined by Dr. Joe Coughlin. He's the director of the MIT Age Lab. He's going to be talking about planning for the 100-year life, which Tom is going to lead the way at. So I encourage y'all to stick around. If you are watching online, you need to go to the website. You're going to log in separately in a new way to access that presentation. Starting at the top of the hour. So it will not be broadcast here. I'm going to turn off this broadcast, and you need to go to the web page and sign into that broadcast separately. So hope you enjoy that message. And then, of course, for all of us here in the room, we will stick around and I will get that presentation on for us. So thank you to everyone for joining us here today. That concludes our capital markets update and outlook call for the month of June. We will have July's date on the website very soon, as well as the next few months. So with that, everyone have a wonderful rest of your day and a wonderful Independence Day holiday weekend. Bye, everybody.